All right, everybody, welcome to the Sherman Show. I am Jeff Sherman here with my co-host Sam Lau.
Hey.
And today we are broadcasting from the DoubleLine offices, and we have a rare treat where we actually have our podcast guest at the DoubleLine office. And so today's guest is none other than Jared Dillian. Welcome to the show, Jared.
Hey, what's up?
Oh man, we're just doing well. Sorry that we had to call an audible here. As I was telling Jared, we were trying to record this a few weeks ago, and somehow I ended up with the chicken pox. So, because we're doing video, I was embarrassed of what I look like as a grown man with chicken pox. But more, and then secondly, we tried to have this with our videographer, and it turns out that one of his assistants got COVID a couple days ago. So, despite all of these trials and tribulations, here we are with none other than Jared Dillian. So, thank you again for your dedication and coming into our office, Jared.
Yeah, this is going to be awesome. Let's do it.
All right. So for those who don't know Jared, here we are just talking about the superstar Jared Dillian. He's the editor of the Daily Dirtnap. He sends out a daily market newsletter for investment professionals, and he's been doing this continuously since 2008. If you go back to Jared's career, he's done a lot of things out there, from being a market maker out here in Cali on the options exchange. He was a trader at Lehman, has great stories about all this. On whether that's index ARB, ETF pricing, and just how to really put that together. And so on top of that, Jared is also a nationally syndicated radio show host where he talks about topics on personal finance. He has all these open lines for listeners to call in. And more importantly, I think I'm more impressed with also his playlist he puts together and his DJ skills. What is it, DJ Stochastic?
Yep, that's right.
Right. So a man after my heart using nerdy math names as his DJ name. So that's why you're here. So awesome, Jared. So thanks again for coming in. Let's just start with a little bit of background. I gave everyone a cursory glimpse into it. Why don't you walk us through to how you got to where you're at today and what led you down the path to be a writer in addition to those sharp DJ skills?
Well, I started out in the Coast Guard. I went to the Coast Guard Academy and I graduated, and I was an officer, went to sea for a couple of years, did some intelligence work, and decided to get out and work on Wall Street. I got my MBA from University of San Francisco, started at Lehman in 2001. As you said, I was on the floor of the PICOs for a little over a year. So when I was at Lehman, Lehman was an incredible place to work. There was something magical about it. It's too bad that it's gone. While I was there, I did index ARB for the first 3 years, and I was made head of the ETF desk in 2004. And the instructions I was given was to market the business. My job wasn't even really so much as being a trader, it was being a marketer and how to increase the profile of the business. At the time, the ETF business was very small. It made about 20 million bucks a year. We were ranked about 8th in terms of the market share rankings. So my plan for this was to write market commentary and write Bloomberg messages and send them out and attract a following. And, I did that every day for 4 years. And my distribution list got bigger and bigger and bigger. I had thousands of people on it. And, at the end, we'd gone from 20 million in revenue to 90 million in revenue. I mean, it just grew, it just exploded, mostly as a result of just writing. So while all this was going on, I said, I found trading to be really stressful, and I had a number of personal challenges. And I said, I need to get out of this business, and I want to be a full-time writer. And I love writing about markets, and did a lot of research on starting a newsletter. And when Lehman went bankrupt in 2008, I walked out the door. I turned down an offer to stay at Barclays, and that's when I started the Daily Dirtnap.
Okay. Well, where'd you come up with the name, the Daily Dirtnap?
So when I was on the P Coast out in San Francisco in like 99, there was, the market makers there had this whole language. They had this whole lexicon of things they used to say. And Dirtnap was the term they used for any time the stock market was going down. So they'd be standing there, with the trading smocks on, and they'd be looking at the screens, and they'd be like, dude, the spoos are taking a hella dirt nap. And they just said,
because you're in San
nap.
Fran, you got to drop the hella in there, right?
Yeah.
Yeah.
So like I just kind of adopted it and I brought it back to New York, and then it became the title of my newsletter. So now like it's everywhere on the East Coast. Like people say it all the time, like the market's taking a dirt nap. So
Yeah. So, I like the interjection of hella. I think Sam used it the other day. He spent some time in the Bay too, and it's one of those things. And I remember when I went to college, I went inland over in Stockton, but they kind of adopt that lexicon, like you said. And there was this very religious woman there, and she always called it hecka because hella to her was a bad word. So that was one I was like, no, you can't adopt that one too. So. So you write a lot about talking about, kind of money flows and sentiment in the market, right? And, sentiment being a kind of large narrative. What are you seeing and talking to your subscribers? And, what are you reading from sentiment today? It seems like we went from this kind of very oversaturated, high levels of liquidity, infusion of capital, whether that, comes from the Fed, the fiscal authorities, there seems to be a little bit of a shift there. And so I'm curious what you're seeing out there with when you listen to investor sentiment today.
well, a couple things, just in no particular order. We had a small correction in the market last week. It lasted for a couple of weeks. And one of the things that I noticed about that correction is that we were having really high amounts of volatility with the market pretty much at all-time highs.
Yeah.
The VIX got up to about 37. You had a lot of realized volatility. You had some pretty violent moves, and there was a lot of dispersion between the big cap tech and some of the smaller names. So some really crazy stuff happening. And, I started trading in 1999, really like during the dot-com bubble. And that's what it was like back then. You had a lot of volatility with the NASDAQ above 5,000, close to the all-time highs. So it always kind of makes me nervous when you have that level of volatility on the highs. Now, with regard to sentiment around inflation, I tweeted about a month ago, a little over a month ago, and I said that the moment that the Fed admits that inflation is not transitory is the moment that it will be transitory. Okay. So, I mean, they capitulated, right? It was capitulation. They watched CPI go to 6.2%, and they finally admitted that it wasn't transitory. And my guess in what we've seen, Fed funds futures have been getting killed. We're now pricing in 3 to 4 rate hikes in 2022, which, by the way, I believe will happen. There are a lot of people that are skeptical of that. And they're betting, they say they'll only hike, once or not at all. I actually think we will get those rate hikes. So I think inflation is going to moderate a little bit. I would
probably not in tomorrow's print, right? That we get tomorrow. I think street expectations are 6-7, I think is what we're seeing out there too. In that, but you're talking about moderation over this kind of 2022, potentially 2023, or when you say moderate, are you thinking like Jay Powell, who's going to say, well, transitory? It doesn't mean that word doesn't mean what you think it means, right?
Well, I mean, it's there's a bunch of things like commodities are starting to act a little bad. I think it's possible that inflation could peak in the short term. When I say the short term, in 2022, with a 6 handle, maybe a 7 handle. But I think it's also possible that we could get CPI back down to 4 or 5 next year, as the Fed gets more aggressive, and we're going to see them start to get more aggressive.
Yeah. So as you think about that aggression, the thing we're trying to square around here, and we've been talking about this in our macro meetings. We had a long discussion about it yesterday. Was what do you think the impact is from the Fed accelerating the taper? The market has talked about, I mean, Powell once again kind of let it slip that they're thinking about doing it quicker. The expectation now, at least amongst economists, is that they're going to unwind additional $30 billion a month starting January and February, because I think they have to announce both, because I think the Fed means too late in January. So they have to do both Jan and Feb. And, can we take that? And I know, you've been writing about inflation for a while and the Fed being a bit behind the curve, but isn't that a pretty rapid pace that we're going to unwind all of these kind of purchase programs? Again, not unwind from a standpoint of unwinding the balance sheet, but we're going to slow this down to no purchases within 5 months. That's half of the speed of where we did, through the last episode. And so do you think that becomes a little problematic for the market, or has the volatility we've seen in treasuries, especially on the front of the curve, really just reflecting that and getting into what you're talking about, the Fed funds futures pricing in 3, potentially 4 hikes next year?
Well, there's a lot there. I do think that they will wrap up the taper by about March. I think the first rate hike will probably be in May. I think that's going to happen. In terms of the impact of the taper, you're talking to a guy, I'm 47. So, I was around, I was trading in 2002, 3, 4, 5, when we used to get like 50 basis point surprise rate hikes.
On the Squawk Box, right? They never telegraphed. They just came across a box and you're like, what? Yeah.
So, so the question is, can the market handle it, is kind of a complicated one. Back 20 years ago, the market was accustomed to those types of unpredictable moves out of the Fed. Today, it's not. They give forward guidance out for 2 years. They tell you what they're going to do 2 years in advance. So, but I do think the market's going to handle it, but there's going to be a lot more volatility. Like, I think what we saw over the last couple of weeks is going to be present for most of 2022. You're looking at an equity market that is going to have 20 in the VIX as a floor, and it's going to spend a lot of time in the high 20s and low 30s.
Yeah. So, is that a good time? Is that a good thing? I think of when you have that elevated vol. Sounds to me that's like a rife environment for like covered call type of strategies, right? For those that want to be a little bit long, augment something. Again, just trying to pick into your brain, how do you take advantage of that, kind of newfound level of VIX volatility, or do you even care about that and you just kind of look elsewhere to find the dispersion you're talking about?
Well, one of the things that you saw a couple of weeks ago is that the index got very expensive. Like, people were going for protection in the S&P and the NASDAQ, and the index got very expensive. Look, like,
when you say index, you're talking about index volatility, right?
Index, index volatility, yeah. So, I'm not a quant. I'm not really like a vol expert. I did trade options for a while, but just from an investor standpoint, you generally want to buy volatility when it's cheap and you want to sell it when it's expensive. So you can sort of build strategies around that.
Okay. So one of the things that you've been writing about, and we just touched on a little bit here as well, is just investor sentiment. Just the role of psychology in investor behavior. And one of the things that we've really took notice of in the last, let's call it 18 to 24 months, is just the rise of retail traders, and just really bringing a different type of risk tolerance alongside with them. The tolerance for moonshots, getting the 5 times, 8 times type of return, but willing to accept that zero alongside, zero return on there. How much of that do you think has played into some of the volatility that you're seeing and expecting for 2022 as we start to unwind some of this monetary policy that's been in place for the better part of that time as well?
Well, the way I look at it in terms of positioning. What's funny about the crypto world is that in crypto they have HODL, right? Like, whether it's hang on for dear life or, hold spell backwards or whatever. But the funny thing about that is that philosophy that people applied to Bitcoin has been applied to stocks as well. And, a lot of the chatter I hear from some of these retail traders is you just never sell, right? So we have, what we saw a couple of weeks ago was, we had a 4% drawdown in the index and everybody bought the dip. And people's cost basis on some of these big cap tech names, whether it's Tesla or Apple or Microsoft or something like that, their cost basis is so low that, if they're up 1,000% and then they're up 800%, they don't care. Like, so it really, the market really has to pull back a lot like significantly more than 10 or 15% before people start liquidating some of this stuff. I mean, people have very strong hands.
Yeah, the diamond hands, as Sam calls them, he's the one that taught me that phrase, albeit way too late. We didn't even know, it's after we got some of those peak prices, we learned about the diamond hands. But, the jury's out on whether this prevalence of retail is a positive or a negative thing for the markets. I kind of lay in the camp that it's definitely at the margin a little more positive, because we have a cohort of investors that just weren't really participating in the markets. And, you can argue that some of them only participate in the crypto side or whatever, but how do you view this rise of the retail community? And is it, in your view, is it a positive? Is it a negative? Is it a wash? People used to always joke about the retail money being the not so smart money, right? The institutional people were smart money, but I was like, has anyone ever talked to a consultant or institutional client? Well, guess what? They are comprised of people. They have emotions. They do the same things. And so, what you find in the retail community seems to be prevalent on the institutional side as well. So unpackage that. And what do you think about the rise of retail?
So I have some pretty strong feelings about that. So if you go back like 4 or 5 years ago, back to 2016, 17, people weren't trading back then, they were investing. The big thing was passive, right? The rise of passive investing, in Vanguard going over 5 trillion in assets, right? Like that was the big thing. Everybody was a Vanguard investor. They were doing passive. Passive became 50% of AUM. People were talking about how it was like market socialism and stuff like that. And the funny thing is that nobody talks about that anymore. Like the whole passive thing just totally went away. And people opened millions of Robinhood accounts and with free commissions just started ripping stocks. So like we just moved on from the passive. Now, the interesting thing about that is, people got upset about that passive movement 4 or 5 years ago. But if you think about it, investors were actually doing the right thing. They were investing long-term. They weren't picking stocks. They weren't underperforming the market. They were dollar cost averaging. Like they were doing exactly what they were supposed to. And then a couple of years later, they just forgot. And now they're trading GameStop and AMC and crypto and stuff like that. So, I view a lot of what's happened in the last 1 or 2 years with retail investing, I view it very negatively. I mean, maybe it's recreational. I mean, if you say to yourself, like, okay, like, I want to punt stocks around, or I want to punt crypto around and, just gamble a little bit. I mean, that, a little bit of speculation is healthy, but I don't think everybody views it that way. I think people view it as a way to get rich and a way to not work and a way to stay at home. I mean, you hear all this stuff about people quitting their jobs and day trading. Like that's not sustainable.
Yeah. Well, I like to remind people, as someone reminded me at our sales retreat last week, when you talk about trying to get rich, 50 Cent said the last part of that is or die trying. So be careful on the other side of that equation. So, we're talking about the rise of the retail too. And that's what I say, I'm on the fence about this as well, because it is the behavior. But what do you think is fueling this market today? I mean, the Fed gets a bad rap. You see all these congressional testimonies right now where they're blaming the fiscal policies of driving inflation today. But, you look at valuation, CAPE ratios are, only the second highest in history. So good news is that they still move to run relative to the tech wreck we saw. What do you feel about the equity market? What's fueling this? And is it just going to be noise and the hodls and the buy the dips, the DCAs are going to win? Or is there really some fear out there that, investors have kind of misplaced, given how strong performance has been across almost all asset classes?
So I'm going to give you kind of a macro answer to that. And I kind of alluded to it earlier when we were talking about the Fed. I think 2022 is going to be a very challenging year. And you asked me if the market could handle the rate hikes or, the tapering. And I mean, ultimately, I think maybe not. Like over the course of 2022, if we completely eliminate the asset purchases and we hike Fed funds to 1.25, something like that, my prediction is that the yield curve is going to be pretty flat. I think that's kind of everybody's prediction. I don't think anybody thinks that long rates are going up. So if you have a flat yield curve or an inverted yield curve and no more QE, then what happens? You know? So and the other part of this, which people
well, then
aren't
also
talking about yet.
let me interject there. So the thing that we've been talking about here is that, well, is it the fiscal side? Do all of
I
a
want to
sudden do
talk
they
about
come
the
in?
fiscal side. Yeah.
Oh,
So
okay, sorry, go ahead.
yeah. So we have midterms coming up in 2022. All else equal, if everything stays the same over the next 11 months, I mean, we're going to have a Republican Congress and Senate. We're going to have a Republican House and Senate. And the model for this is what happened in 1994 and 2010. In 1994, Clinton's midterms, then Obama's midterms, you had these huge Republican wipeouts.
Yep.
And then you had 6 years of austerity during both Clinton and Obama. I mean, during the financial crisis, the budget deficit got to 1.8 trillion, and then it went down to 435 billion, which was like 2% of GDP. I mean, we really cut the deficit. So that could happen in 2022. So if you take away the monetary stimulus and you take away the fiscal stimulus, what next?
Yeah, and that's one of the things too. I mean, up until now, we didn't really mention it, but just some of the driver, some of the strength that we saw out of 2020 and into this year is just fiscal stimulus into with money into people's pockets, right? That's really, excuse me, that probably had a large impact, especially on the retail side, on the newer entrants into the market, getting this money, and then with the technological advancements and just the availability of brokerage. Online brokerages for these individuals being able to pump some cash into some of these stocks there. But since we're talking about some of the fiscal deficit and ballooning debt, I mean, what is given the level of debt levels that we're at today, especially relative to GDP? I mean, we're at times that we're at levels where we haven't seen debt to GDP ratios since World War II. It's a much different type of economy back then. What are your thoughts around the absorption of some of the supply that's been going out? How do we wind down this debt level, this federal debt level that we have here in the U.S. and in other developed market countries, or do we? I mean, what's the end game around some of this rising debt?
I mean, theoretically, if we started now, if we had the political will to reduce the debt, if we started now, we could do it in 20 or 30 years. And we could go from 130% debt to GDP to about 50 or 60% of debt to GDP if we were committed to doing it. Now, the funny thing is that, I remember when I was a kid, this was like 1983, I was in fourth grade, okay? And we used to have these current events things in my fourth grade class. And every week we would have these current events film strips, and all they could talk about was the deficit. And at the time, Reagan was president. And we had $180 billion deficit, which was about 5 or 6% of GDP. And people were freaking out about the deficit. So, George H.W. Bush was forced to raise taxes, and Bill Clinton campaigned on reducing the deficit. And then we ran a surplus in 2000. But
right. Well, didn't H.W., didn't he call it voodoo economics when he was running the primaries against Reagan, right? So
yeah. So, I mean, but the point is that the political will to reduce the deficit in the 80s and 90s was there. Now, nobody cares. Nobody cares. There's no, like, if you look at a Pew or Gallup poll of like all the issues that people are voting on, whether it's crime or the economy or the debt does not even make the list. Like, people don't see how it affects them in their personal lives. And, you could make the argument today, if you had a politician that was articulate enough, they could say, this is, the inflation that we are experiencing right now is how this affects your personal life.
Yeah. Well, and I think people are too focused on whether to wear a mask or not, right? There's some other things that have risen in that polarity there. So you talk about the deficit and this like political wherewithal or lack thereof. I look at the economy right now, and all I see is negative real yields everywhere, right? With this inflationary component. So, the argument always in the government is that, we're going to grow our way out of it, right? That's what that's how the CBO rationalizes a lot of these budget plans that we put out there. But, historically, the old joke I like to use is that, you get about half the benefit the government promised you and it costs 2x, right? So you never quite get there. But when I look across the environment, I look at, TIPS yields, like on the long bond, they're negative 100 basis points. I look at the real funds rate, Fed funds is roughly zero today. You put on inflation, pick your favorite number now, it's at least 6.5, let's call it, right? So look how negative that real yield curve is. So, this is where you should be taking on that level of debt. And we're seeing that somewhat in the corporate space, right? We've seen that. But there's been a little bit of reluctance to really pile it on massively. And so is that something that we're potentially missing at this point? Is that, there could be this new wave of CapEx and M&A that come from, corporate America, because cost of funds not only nominally is cheap, but on a real basis, I mean, is ridiculously cheap. It's Jimmy Carter cheap, as we've been saying around here. What do you think about that kind of concept?
I don't have a complete answer for that, but I can tell you that it's my personal opinion that negative real rates are the worst things in the world. And if you look at a chart of real rates over time, the periods in history when we've had negative real rates have been the worst. It's been the worst times in history. And if you have negative 6% real rates, that means that a project that has a return of negative 2% is profitable,
Yeah, right.
which means you're destroying capital.
Right.
That's the distortions that are created by these negative real rates.
Right. That's the NPV problem, right, from business school.
Yeah. So I don't have an answer to that question. I really don't. I mean, the thing with, you have Janet Yellen as Treasury Secretary. There's a lot of people in the administration that believe that, sure, rates are low, we should be issuing as much debt as possible. And there's a lot of people who believe that the aggregate level of debt is actually causing rates to go down more. So I think this ends in a supernova. Like, I don't know how this ends.
Yeah. Well, maybe it's like the old song, maybe it's a champagne supernova in the sky, right? So it feels like it with the punch bowl and everything. So let's step back in all of this too. And so, we're talking about some of the challenges out there. What are some of the risks you've been identifying out there to investors where you think they should tread lightly? And, I'm not talking about the blatant ones where, it's Chinese real estate or, the regulation on tech stocks, but what are some of the things, with your experience and, what you're watching out there that you think are some of the kind of hidden risk out there that people should be more cognizant of today?
I focus on sentiment. Okay. So one of the things I was warning people about in the newsletter about a month ago was that sentiment and energy was getting too hot. It was getting really, really hot. And people had, there was a lot of people who, bought the lows in 2020 when oil went negative. They rode it all the way up and they were taking a lot of victory laps. And I said, this is a problem. And then, WTI goes from 85 to 63, like on a frozen road. So that's, I'm being the sentiment guy. I kind of look out for when sentiment gets very hot or cold for opportunities.
What are some of the other markets that you're seeing some overheated sentiment perhaps, and where are some of the opportunities?
Well, one of the areas where sentiment is very negative is EM. And I've been trying to think a lot about EM in the last couple of weeks. The problem is that, the politics in some of, they used to call them the BRICS back in 2000, but, the politics in some of the BRICS is making some of these countries uninvestable. But on the other hand, when something gets to the point where it's uninvestable, it's usually a pretty good trade. So
another thing you've spoken about, and it's a completely very popular thematic concept, is this one of ESG, the environmental and social and governance being a prominent part of the investment thesis. Maybe you could elucidate our listeners and our viewers out there on how Mr. Dillian thinks about, the ESG movement here.
So I actually developed a theory on this in the newsletter, and I wrote about it in Bloomberg Opinion. I'll later on, I'll show you the article because I wanted to get it on the internet, like on the record, but I called it the theory of constraints. Okay. So let's say you have two portfolio managers and one of them is unconstrained and they can invest in anything. They don't have any limitations. And the other portfolio manager has constraints. They can't invest in tobacco stocks and weapon stocks and energy stocks and stuff like that. Well, the problem is that how can you possibly expect a portfolio manager with constraints to outperform a portfolio manager without constraints over time, over some long period of time? And the stocks that have constraints on them must offer a higher rate of return in order to induce the unconstrained investors to buy them. And that's exactly what happened in 2020 with energy. It's exactly what happened.
Yeah, I mean, we've seen it in tobacco stocks as well, too. I mean, some of the best performing stocks out there. And so, is it the role of capitalism to try to help with these movements, or does it really come down to, as you just said, at the end of the day, it's an IRR or it's an above average return, or there's some incremental premium that you're getting paid for it. And, you can fix it on the back end. I think I've read you saying that before, that instead of, trying to do social causes, why not make more money, build up the nest egg, and be more of a philanthropist over time? So maybe I'm leading the witness here, but, how do you think about that?
Well, one of the nice things about the ESG movement is that it didn't come from government, okay? Like when we were divesting coal and natural gas and oil, it wasn't coming from the government. This was a private sector phenomenon, and said we were going to starve these entities of capital. Right now, that had consequences, and some of them were unintended, but it was led by the market, which I think is actually a good thing.
Yeah. I've got some guys banging on my roof right now, putting in the solar panels as well. So I'm concerned about being out here in California with all these blackouts and everything we have. So again, trying to do it for the greater good, but also for a self-serving reason. But I hate when the power goes out. So let's think about positioning too. What are you kind of recommending out to your clients out there today? Are people too long positions, and you're thinking about something else? Like what comes out in Jared's recommendation of trying to capture the opportunity set? Is it dry powder, as you talk about some of this vol coming together? Is it, using some sort of bonds or bond-like proxies to offset some of that? What are you thinking about?
Well, really the problem comes down to asset allocation, okay? So if you look at the typical individual investor's asset allocation, it's 80% stocks, 90% stocks, 100% stocks. It's kind of hard to justify investing in treasuries at 1.5% or corporates at 3.5%. It just doesn't make any sense. So people aren't doing it. But they have these asset allocations that are very heavily weighted towards equities, which makes them vulnerable to a bear market. So what I've been trying to get people to do, I called this the awesome portfolio, which is kind of a stupid name, but that's what I call it.
No, I mean, sign me up. I mean, I want the awesome portfolio. I don't want the crappy portfolio. I want the awesome portfolio, right? Yeah.
So the awesome portfolio is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. If you take this portfolio and if you allocate this, if let's say you did VTI for stocks, okay, and AGG for bonds.
So you're just using broad index
just broad
ETFs
index
out there. Right?
Yep.
Yeah.
If you did this since 1971, over the last 50 years, this portfolio has returned 8.2% annually with half the volatility of the S&P. So, sorry, not the S&P, but an 80-20 portfolio. So you're getting almost the return of the index with half the volatility of an 80-20 portfolio. And the max drawdown of this portfolio in the last 50 years is 9.2% in 2008.
Yeah, and I have my compliance guys sitting here just staring at me very, very vehemently. So we're going to tell all of our listeners that past performance is not indicative of future returns. And, anything that Jared advises you is probably going to lose you a lot of money. So, he's now chuckling a little bit. So that's good. So we keep a compliance friendly environment. But no, I mean, it's pretty amazing because, you're talking about volatility and drawdowns. And when you have this kind of bull market runs, people are like, yeah, but that's just stupid. What am I going to do with that? I just want to make 20, 30, 40% a year. And so I think that's where you get that kind of sentiment indicator too. So is the sentiment also driving this thing about, how rich some of the valuations are in the space? And, does that lead it? Or is this just the awesome portfolio is just so awesome that it's an evergreen idea?
Well, I'm going to back up a little bit. And what I'm going to say is that in this environment, all people care about is returns, what returns the most, but you have to care about risk. Now, you get these stupid financial publications that every once in a while say, why do people invest in hedge funds? They return less than the S&P. Well, it's because if you're a wealthy investor, you don't just care about returns, you care about risk, you care about your max drawdown. And the reason that matters is because if you have a big drawdown, that affects your psychology. So if you take a 30% hit, then you're likely to panic and liquidate at the worst possible times. If you can stay invested in something that doesn't give you that volatility, that gives you, a very small drawdown here and there, then you can stay invested and keep compounding over time.
Yeah. And we know the most powerful force in all of the physical sciences is compounding, right?
Yep.
Yeah, right. So Jared, we're running out of time here, but I want to give you a last chance to give me what's the most topical thing that's on the top of your mind right now, that as you leave here and you're going to go have hors d'oeuvres and cocktails with your subscribers, what are you going to press onto them today? And that's one key takeaway that they should take away from our episode.
Well, I think looking ahead, I think it's the Fed. And I think it's the Fed getting aggressive in 2022. And I think it is inflation moderating somewhat. And I think that 2022 is going to be very choppy for stocks.
Okay. All right. Well, you heard it here first. His clients are going to hear it in about an hour. So we got that for Sherman Show listeners. Unfortunately, our release calendar puts this out in about a week. So it'll be stale by then. So we're not going to front run your subscribers out there on this knowledge there. So Jared, I really appreciate you taking time, working throughout my schedule with my childhood disease I just got. And, coming into our office, it's great to see you. But before we let you go, I want to first give you the opportunity. How can people follow the work you do? I know I follow you on Twitter. I get a lot of your emails out there. What's the best way to get into your writings and the stuff you put out in the world?
Best thing to do is to subscribe to the Daily Dirtnap. You can go to dailydirtnap.com. There's a button that says subscribe. You can send me an email. You can sign up that way. I also have a podcast. It's more of a personal finance podcast. It's called the Be Smart Podcast. So you can check that out. They're pretty short episodes, about 12 to 15 minutes. Very well done. And also I'm an editorial columnist. I write for Bloomberg, so I publish pieces on Bloomberg Opinion periodically.
All right. So be smart, buy the awesome portfolio, and just stay fully invested all the time, right? Yeah.
Well, it does have 20% cash in it.
Yeah. And also, well, that's still an investment, right? If that's your investment objective, that you're fully invested. However, also you're not here selling yourself. Where do they get some of your playlists for DJ Stochastic?
Yeah, so I have a website. It's djstochastic.com. Most of my music is on SoundCloud, and I'm Stochastic, DJ Stochastic on SoundCloud. So soundcloud.com/DJ Stochastic. I also do events in New York City about 3 or 4 times a year. The next one is going to be on April 1st at Do Supper Club. Just keep an eye on my Twitter feed. I'll be tweeting about that. You can come to the next party.
All right, right on. April Fool's Day. What better way to get together? Here's some good tunes that are spun by you. And, obviously we're going to talk some finance on the side. So thanks again, Jared. However, before we let you leave the confines of the DoubleLine office, we've got to introduce you to Sam's favorite part of the show. So Sam, take it away.
All right, Jared. And that favorite part of the show is called Sherman Says. I will offer a series of alternating prompts between you and Sherman, to which I hope to elicit a top of mind yet concise response. So to kind of give you the example, I'll throw one out to Sherman first with yield curve.
Flattening like a pancake.
For you, Jared, it's going to be 10 bagger.
See, we read your stuff. That's your most recent letter as of today.
Yeah, I've yet to get a 10 bagger without leverage in my entire life.
I personally got my first one in 2021 of something I owned. And let's just say it's not what you think, but I contend it got caught up in the meme craze because it went up 5x in 2 days, to which I ran to compliance, asked to sell, and I said, I know nothing about this stock except I want out. So
Except that's been up five times.
Yeah. And I'm like, I know nothing. I contend to, and they're like, obviously you know nothing. You never buy stocks that go up a lot. So
all right, this one back to you, Sherman, with rate hikes.
I'm going to fade Jared here, and I'm going to say 2 hikes next year because I think it's going to be problematic. However, I agree with the entire thesis of inflation being there, but I think it's going to cause a little bit of problems with the taper. I think they're going to hike, but I think they're going to be a little more patient, and I think they're going to go back to this kind of quarterly hiking schedule. So maybe we get to 3. Again, I'm not here to insult him. He has a chance to refute it and rebut it, but I kind of like fading a little bit of that. I think the curve's a little too aggressive on the pricing today. But who the hell is excited about a 69 basis point 2-year, right? Even if I'm right, that's what I'm saying. If I'm right and we're fading the curve and it rallies to 50, okay, I get a 20 basis point move. I make my carry all in. I'll be lucky to get like 95 basis points total return over the year. Whoop-dee-doo, right? Especially with inflation. So although I like the concept, not something I recommend putting money in.
All right. Back over to you, Jared, with demand destruction.
I actually think that a lot of people say, how are rate hikes going to fix the supply chain crisis? And I say, actually, rate hikes really do fix the supply chain crisis, because I believe that most of the supply chain crisis is demand driven. I think most of it is driven by demand. So throw a couple of rate hikes in there, tighten monetary policy. I think that reduces demand, and I think things ease up.
Yeah, I was telling one of our portfolio managers that, because that contention was thrown around, and I said, yeah, rate hikes could cure it. Raise rates 500 basis points. There's going to be a huge bid for money market. Right, that demand goes away all of a sudden, right? You're like 5% of my money. I think a lot of us have a lot of 5% risk-free assets we'd like to deploy. So again, you destroy the market, you destroy some other parts, but possible but not plausible, right?
All right, back to you, Sherman, with pricing power.
Better to have it than not to.
Jared, maximum employment.
3.5%.
Unemployment rate, right? That's what you're saying? Yeah. It seems
Well,
right. That's where we were last time, right?
Yep.
That's where we got to, yeah.
Right there, yeah. Back to you, Sherman, with, let's see here, monetary policy error.
I'm trying to think of a good one-word response here, but it's ongoing. I think, what we've done since the GFC, I tried to come up with some great answer there, but
you could have just said Trichet.
Ooh, that's very good. I think that the policy we've been pursuing with QE and what Jared's talking about, is been a problematic. And like, you look at GDP growth, it's all been driven by debt. And, is that healthy? No, but, all in all, I think that, we've gotten used to the monetary policy errors. I think, as much QE as we've done in 2021, I think we should have throttled it back a lot sooner. I'd really seen a smoother path to it. But, again, 900 PhDs in the Fed, and they're no better at forecasting than any of us. So my diatribe is over, Sam.
All right. I'm going to kick it back to Jared then with the persistence of meme stonks.
I would not be long any meme stonks in 2022.
All right. And then
Because he didn't say to short him. Didn't say to short him.
That's a tough game. All right, Sherman, Metaverse.
I'm just living in this universe and I don't understand the metaverse, man. It's just beyond me, but we'll figure it out. I feel like, the metaverse is really an extension of what we're doing today. Zoom, Teams, all of these technologies. It's kind of what it is, but I don't know. I have trouble forking over my hard-earned cash to buy some digital land next to Snoop Dogg out there, which I saw was going for like $1 million or something, which is crazy.
Million seems cheap on some of these other bids that people have been
Yeah, I'll take some California coastal real estate at $1 million, undeveloped in the Malibu area. If I was, I'd prefer that. Let's say.
Yeah, I think we're getting one step closer to your vision of the metaverse here. With I think they're talking about putting avatars out for all of our employees here in case they don't want to pop up in real life. So put up your avatar. We'll see how ours look. Right.
I can't wait to see what they do to us.
Yeah. All right, and then let's close up shop here, Jared, with the last one to you for tyranny of the mid curve.
Oh yeah. Yeah, that's a meme that's been going around for a while. The high IQ people and the low IQ people will understand the concept, and the people in the middle don't. That's actually, it's funny because it's actually true. It's actually true, so.
Yeah, well, no one wants to hear that, right? It always reminds me of the whole, what was the example of Lake Wobegon, right? Where everybody's above average, which by definition can never happen, right? So I think the only time I've ever seen that people think that they're all above average is if you ask them about their driving skills, right? And I'll be the first to admit I'm definitely not an above average driver. I try to tend into it and just try to be good enough, right? Good enough to not hit anybody and not get hit, right? So anyway, you can see we're in the random mode today, Jared. So thank you so much for spending the time with us. We really appreciate it. This is Jared Dillian, Daily Dirtnap. Again, you can check out his website, dailydirtnap.com. You can follow him on Twitter. Jared, what's your Twitter handle?
At Daily Dirtnap.
There you go. I mean, you got the market cornered in Daily Dirtnap. So
yeah.
Thanks for taking the time today. If you guys want to see what we look like here in the office today, you could have caught this episode on our YouTube channel, youtube.com/DoubleLine Capital, all one word in there. You can also catch our podcast on SoundCloud, Stitcher, Google Play, iTunes, some other things I have no idea about. Our PR folks keep us going there. And more importantly, you can see Sam's moonlighting gig that he does weekly. He's going to record that tomorrow on his Monday morning minutes that they do after the bell every Friday, and they release before the open on Monday, where they cover all things macroeconomic and markets, giving you a quick recap. Lastly, don't forget on the YouTube channel, you can look at our channel 11, which is hosted by portfolio manager Ken Shinoda. Great stuff out there, content. That's a monthly publication out there. So subscribe. You can get us on the Twitterverse. Are we in the Metaverse yet? Twitter's not there. That's Facebook, right, Sam?
I don't even know.
Yeah. Okay. So our tweeter's at Sherman Show Pod. We don't have the market cornered in Sherman shows out there. There happens to be another cartoon out there. So we're not as talented as Jared when it comes to getting that. So appreciate everyone for listening. Stay tuned. We'll see you in 2022. We'll talk about the beginning of markets and our outlooks on the first podcast of 2022. Once again, thanks to our guest, Jared Dillian. Thank you, Jared.